welcome each and every one of you to our Wealth Transfer Seminar. We know that many of you have gone out of your way and deviated from your normal schedule in order to be here this evening. We would like to extend our assurance to you that we've gone to great efforts in doing our utmost to justify any inconvenience that you may have incurred. And to those of you who we can't satisfy in this area, perhaps we can appease you with our modest cuisine and drinks. A prime example of this is that through our affiliation with CAP Planning, our associate organization, we were fortunate to have them engage tonight's eminent attorney and speaker, Arthur SEDERBAUM. Mr. SEDERBAUM is a much sought-after speaker, and he has applied his broad knowledge and expertise to a variety of professional groups and business executives, such as yourself. Not surprisingly, he has served as an estate planning consultant to other attorneys who are engaged in estate work. We are confident that you will all leave here with useful concepts and ideas that can help to enhance your present estate plan, whatever that may be at this moment in time. The topic of our seminar was not at all difficult for us to select. On the contrary, due to the unique qualities of businesses in our community, our subject for tonight was a natural one. An unusual number of businesses within this community are predominantly close family businesses. Many may not have started this way, but with the passing of time and with children advancing to adulthood, these children were brought into the company. As a result, we have companies today that are comprised of 6, 8, and in some cases, as many as 10 family members. The benefits of this are many, but so are the concurrent problems. And one of the major problems is what we will be dealing with this evening. You can safely say that tonight's subject was custom designed for you, our guests. We hope that in addition to the main purpose of tonight's meeting, you will derive some further pleasure and fringe benefits generated from the beautiful surroundings we are in and the overall beauty of this magnificent building. Now, I'm pleased to turn your attention to my associate, Harold Wilczynski, the founder of CAP Planning Limited, and someone who over 30 years ago brought Eddie and I into this business. Hal has worked closely with us over the years in helping to implement some of the creative and innovative estate plans coordinated with life insurance in some cases for many of the top families in the community. Hal, can I have you step up? Thank you.
Thank you, Ray. It's a pleasure to be here with you tonight. And frankly, this seminar has special meaning for me because it's about 32 years ago that I and Ed and Ray Shweky got together and they joined me in the life insurance business. And it's been very fruitful 32 years. I've watched them grow professionally. I've watched them grow in their business activities, and it's interesting how they committed themselves 100% to working within your community. About 4 years ago, they decided it was time to bring a new generation in, and they had Jack Rami join them so that they, in effect, would assure continuity of the quality service that they've come to believe that your community has expected of them. You know, the complexity of today's tax laws and the number of products in the insurance and investment community that we deal with today. We represent over 80 insurance companies and investment organizations. And frankly, in view of all of that, Ed, Ray, and Jack have worked with us considerably to make sure that they can provide the high level of sophisticated planning that you and your community require. And frankly, as far as they're concerned and I'm concerned, you deserve no less than the kind of cutting-edge quality planning that you need today to deal with the kind of tax environment that you're operating in. This seminar deals with that kind of treatment of gift and estate tax savings ideas and concepts. fact is that tonight, life insurance is going to take a back seat to anything we're going to talk about. Not that we're operating a nonprofit charity, but there are certain developments out there that you'll be hearing about from our speaker that, in effect, literally have reopened doors on meaningful planning concepts that, as recently as 2 years ago, the experts and the professionals in the community thought they were closed. Speaking about experts and professionals in the community, I saw two of them, Neil Goldstein, Joe Rishley, there they are. Just join us from a very eminent law firm that works within your community, and we've worked with them in the past. I'm delighted to present Arthur SEDERBAUM of Patterson, Belknap, Webb, and Tyler to speak on the subject that we had outlined. That's wealth transfer techniques for family business and real estate interests. Rather than start rehashing Arthur's credentials and background, you have it all laid out in the page following the agenda that you have in that package we've prepared. So, without any further ado, why don't we let our speaker come up here and do his thing. Arthur?
Thank you. No funny stories to start with tonight, guys. Because that ain't funny. That is the top estate tax bracket. And it begins at taxable estates of $3 million, a federal rate of 55%, and a state rate on top of that of 5%. Additional in New York, if you're fortunate enough to convince New York that you're a Florida domiciliary, it's only 55%. New Jersey is somewhere between 55 and 60%. That ain't a laughing matter. And as many of you know, the marital deduction is not an avoidance of tax. All it is a deferral, which means that if you're survived by your wife on your death, I don't care what size your estate is, if it's planned correctly, your estate will pay no taxes. That's fine, and that's very important because you get the use of that tax money, which you would have paid, for the period of time between the death of the husband and the death of the wife. But there's a big hit there. And that hit is something that can literally cripple a family business. I've seen it happen, and I've seen it happen when the first time someone comes into the estate planning attorney's office is after Shiva's been sent. Well, there are things that you can do, but it certainly would be a lot better if it happened before that time. Okay. What can we do to get rid of that? What can we do to minimize it? Well, our job has been made much harder since 1976, and I think it's good to do a little bit of history here so that you know how this tax system works, because knowing how it works will make you better appreciate what you can do to minimize the taxes. Before 1976, there were two different taxes, an estate tax and a gift tax. You made gifts during your life, and once you exceeded a $30,000 lifetime exemption, you paid a gift tax. And at your death, you paid an estate tax. But there were the gift tax, that's gift. Mom always wanted me to become a doctor, so that's gift and that's estate. And each one had a bracket, which started at 17%, and it worked its way up at 1976. Its highest rate was 70%. But if you made gifts, there were two distinct advantages to making them. Number one, you got the gift property out of your estate, and number two, you were taxed at a much lower rate, because what you did is that you were taking it out of your estate. In other words, if you had held on to the property at your death, you would have been taxed at the top rate, but you got it out of this rate, and you started here. And you started working your way up, and so there would come a point in time when it would become too expensive to make gifts, but you could save lots of dollars in doing that. Congress did not like that. Congress said, oh, this is a sop to the rich, and we want to do away with that. So what Congress did beginning in 1977 is unify the tax system. Wanted to make the benefits of gift giving minimal, so that the impact of making a gift would be the same as dying with the property. And so what they did is that they unified the tax rate structure. There was only one structure. And so you started making gifts, and if you made gifts up to here, let's say on the structure, and died with this amount of property, this amount of property was added to the gifts that you made so that you could move up the brackets. And so you would take this amount, subtract this amount, because you'd already paid taxes on that, and that would be your tax. In other words, your estate was accumulated onto your gifts, and so it was taxed at the marginal rate, which meant that there were only 3 advantages left in making gifts. And that is the essence of estate planning. The essence of estate planning is diminishing your estate. And the only way that the law will tell you that you can diminish your estate is to make a gift. That is to give up the control of the property to somebody else. If I hand Joe Shalom $10,000, I made a gift to him. I can't get the $10,000 back. And he can go out and blow it on the ponies if he wants to. Now, I may not want him to do that. And so the essence of good estate planning is trying to put strings on that gift wherein the law tells me that I can't make strings. So, in review, the essence of estate planning is making gifts, and what Congress tried to do is take away the advantages of making gifts. What we're going to do tonight, for the next, about 45 minutes or so, is to talk about how the advantages of gifts are still here and what we can do to maximize the gift giving. Okay, there are basically only 3 advantages left in making gifts. Those 3 advantages are the key to successful estate planning. We're going to start small, we're going to work our way to big. The first advantage to making gifts, I'll just put down $10,000 here, because that's the annual exclusion. Don't minimize that, because you and your wife together can make $20,000. Now take the number of people whom you wouldn't mind, if you could afford it, making gifts to. Your children, your grandchildren, maybe nieces and nephews, and it can add up. $20,000 a year times the number of people that you want to make gifts to, and that can add up over a period of years. An organized gift-giving program. You can see how much that will take out of your estate. Now, why is that not accumulated? Because the law tells us that it's not. The law tells us that what we can do is that we get a deduction from our gross gifts that we've made for $10,000 of gift made to each individual. And if a spouse joins with us, that's $20,000. Now, there are certain restrictions on that, which we won't get into, but basically it's a gift of what's called a present interest. We must make sure, in order to qualify for the $10,000, that the individual can get his or her hands on it in some kind of way. All right? The second advantage to making gifts. That word is appreciation. If I make a gift today and the property is worth $100, and if I held that property to my death and that property would be worth $1,000, have I not benefited by $900 the gift that I'm going to make? An appreciating asset is the best candidate for making gifts. Okay? And a garden variety appreciating asset is life insurance. Because the value of life insurance today, if its term insurance is minimal because it's only the unexpired premium, and if it's ordinary life or universal life insurance, it is, for all intents and purposes, the cash value of the insurance, which is much, much less than what the proceeds would be at one's death. Life insurance is really a garden variety candidate for planning your estate. As a matter of fact, many people don't really recognize the fact that life insurance is includable in your estate for tax purposes. Because most people say, hey, life insurance passes outside of my estate. It passes outside of my will. It goes to my beneficiary. However, it may pass outside of your will for descent purposes, but for tax purposes, if you, the insured, have the right to change the beneficiary, if you have the right to select settlement options, and if you have other what's called incidents of ownership, that gross proceeds, death benefits, will be includable in your estate, even though you have no benefit from it. And so life insurance is the garden variety asset that should be gifted, because you're taking it out of your estate at a very low value, the unexpired premium or the cash value, and if you held on to it, the entire death benefit would be includable in your estate. And so we have means for doing that. Now, all this is by way of introduction to what the third benefit of making gift is, and what the whole rest of the discussion is going to be about. Leverage. That is, the asset may be worth, as far as we're concerned, X dollars, but for valuation purposes, for gift purposes, it may be worth 2, 3, 4, or 5 times less than that. And those are the techniques that we're going to be talking about. I have an outline here which I'm not going to distribute until the end, because I think it would be better to listen, to ask questions, and to just try to get the basic concepts down, and then this outline can serve as a review of what we're talking about today. The leverage means that the value of the asset today is much less than the value it's going to be in the future. And it is basically using interest rates to our advantage. Let's take an example. If I say to Joe, Joe, I'm giving you $10,000. What's the value of my gift? The value is $10,000. But if I say to Joe, I'm giving you the $10,000, but you're going to have to wait 10 years to get it. Now, I've still made a gift because there's no way I can get it back. In 10 years, I must give it to Joe. Is not the value of the gift, that is the value of Joe's right to receive $10,000 10 years from now, much less. Does everyone see why it's worth less? Because that $10,000 is going to be earning interest. And that interest will be denied to Joe. And we look up in various tables, once we know what our assumed interest rate will be, what the value of the right to receive $10,000 in the future is. For example, if I own a promissory note to say that in 10 years I'll be getting $10,000, and I can hock that note at a bank, the bank isn't going to give me $10,000 for it, it will give me something less. It will give me what it's called the present value of that note. Now, IRS each month publishes interest rates. It publishes interest rates for the month, assuming what the rate of return will be. So back to my example. If I say, Joe, you're going to get $10,000 10 years from now, I look at the IRS interest rate assumption for the month of June, which is 7.8%. It is tied to the midterm Treasury bill rate from 3 to 10 years of Treasury bills. And thus, I can value the right to receive $10,000 10 years from now. That would be discounted by approximately 50%. Okay? So therefore, my making a gift to Joe of $10,000 to take effect 10 years from now, the value of my gift is only $5,000. I have gotten $10,000 out of my estate because the asset is worth $10,000. But because he is getting it at a future point in time, the value of that gift for tax purposes is only $5,000. Are there any questions on the concept of present value? and how we go about valuing gifts.
What happens to the interest as we accumulate on?
Okay, that is the perfect segue to the next part. The question was, what happens to the interest? And the answer is, in 3 words, it all depends. There are 3 techniques we're going to talk about which answer that question and would say, from the practical application, from $10,000 to the family business worth many times that, how that operates in the estate planning context. They are the grantor retained annuity trust, the charitable lead trust, and the grantor retained income trust. Grits and grats. Many of you may have heard of that. Let's vary our example for a minute. And let's make it more realistic. And let's say that I own a piece of real estate, either in a corporation whose major asset is that piece of real estate, or a partnership, or the family business. You can take either one of them. And let's say that we can get an appraisal of that real estate of $2,800,000. I'm taking the numbers because it's right in the outline here, so when you read it and you review it, you can see what we're working on. Okay? I can get an appraisal that that real estate is $2,800,000. Now, you don't have the outline yet. I'm going to hand it out afterwards. I just want you to follow the example. And that real estate is throwing off $350,000 net to me a year, 12.5%. Okay? But I can get an appraisal that it's worth $2,800,000. All right? So I create a trust that says, okay, my son, in 8 years, you are going to receive this piece of real estate, either in the corporate form, or as my partnership interest, or you're going to receive the family business, which is worth $2,800,000 by appraisal. But during those 8 years, I'm going to retain an annuity. I'm going to retain the right to receive $350,000 a year, which is what the real estate is throwing off, which is what I know the family business can produce to me, what my S corporation dividend would be, what my partnership would be. Okay? What is the value of my gift? Is the value of my gift $2,800,000? My son has to wait 8 years to get this. Okay? What is my discount? Well, remember I said that IRS is using, for the month of June, an assumed rate of return of 7.8%. That is, for lack of a better term, the law of the case. In other words, IRS is assuming that every asset transferred in the month of June, I don't care if the asset is a shoe or a piece of real estate, is going to produce 7.8%. But my asset here is producing 12.5%. Irrelevant. IRS assumes that it's going to produce 7.8%. Okay, but I've just created a trust which says, pay me, the grantor, 12.5% for 8 years. And at the end of the 8 years, it will go to my son. Well, let's just take $1 million, for example. If the trust has to pay me $125,000, but IRS tells me that the income it's going to receive is only $78,000, where are you going to get the $47,000? Where are you going to get it? You're going to get it from the principal. Okay? So that means that at the end of year 1, you don't have $1 million anymore. You only have $953,000, which in year 2 will produce another 7.8%, but you've got to pay $125,000. And so, my actuarial tables tell me that at the end of 8 years, by this constant invasion of, fictitious invasion of principal, there will only be $230,000 left. Even though $1 million is going to pass to my son. I have transferred $1 million to my son, I have retained the distributions from that asset, and still my gift tax value, my gift value that I have to include on a gift tax return is 77% discounted. And as a matter of fact, if I moved it up to 12 years, the discount is 100%. Because at the end of 12 years, paying out 12.5%, but assuming an income received of only 7.8%, that means at the end of 12 years, there will be, fictitiously, nothing left. I have transferred the whole asset, and my gift value is 0. Now you understand how the government is letting you get away with this. The government is letting you get away with this because what you are doing is taking their interest rate assumption and hoisting them on their own petard. Because we know that in commercial transactions today, that we can get appraisals of $1 million on a $125,000 return, because no person is going to go into a transaction, no person is going to buy a business without these rates of return. No person is going to buy a piece of real estate without this return. But since the government is keying their interest rates to the average of 3 to 10-year Treasury bills, we get this break on the interest rate. We are leveraging our assumptions. So now we can see that there are a lot of advantages to this grantor retained annuity trust. What you're doing is getting a very expensive asset out of your estate for minimal or maybe even 0 gift consequences. This has been the way, this has been the major way that I have moved stock in the family business down generations at minimal taxes. And as a matter of fact, just to tell you one more story, I had an example of a family business that was owned by 2 families, 50-50 each. And the shareholders' agreement, the way it was written, said that the stock would be redeemed when someone died. Well, that was no problem if everyone died when they were supposed to. The only problem is, tragically, the second generation. There were 2 individuals in each family that owned stock. Unfortunately, 2 members of the same family in the second generation predeceased the first generation. So it came, as it shook down, that family A owned 75% of the stock, and family B owned 25% of the stock. And so we got them together and said they all recognized that it was very important for this business to continue, that the 2 families owned 50-50. But certainly, the old lady who owned the majority of that 75% had really no objection of making a gift to the family B member, provided that she wasn't out of pocket these staggering gift tax costs. We did a grantor retained annuity trust. What she retained, the grantor retained, was the returns from the business that she was always getting, and she was very happy to continue to get that for a period of time. However, if you take nothing out of this, remember there's no free lunch in estate planning. There is always a quid pro quo, or a risk. You must pick a number of years in which you know that the grantor will survive. Okay? Because if you make a transfer, and at the moment of your death you had the right to receive the benefits of the transfer, the income or the annuity, that present value of the transfer will be recaptured into your estate. Okay? It's really a no-lose situation, because you'd be back to square one as if you hadn't done anything. But in structuring these, you pick a number of years which you think the odds are pretty good you will outlive. And as a matter of fact, we have, in several instances, we had a situation in which the wife of the grantor was significantly younger than he was. We went to the other shareholders and said, would you mind if the wife were the owner of the stock for 6 to 8 months? Because we can't, I think if IRS ever got wind of it, and you can never go under the assumption that they won't. They wouldn't take him too kindly to the fact that husband transferred to wife, and then 3 seconds later the wife created this grantor retained annuity trust. The shareholders said, fine, and so we used the wife as the measuring age. She retained the annuity. It was includable in the gross income of a joint return. The husband didn't care, the other shareholders didn't care. We got the bang for the buck. The grantor retained annuity trust is a key component of the leverage of the gift planning, of the passing of the business, of the passing of real estate. Because to the extent that you've got an asset that can exceed this return, now I don't know what the return will be for the month of July, you just got to play it month by month, then what you will do is be able to leverage, and leverage effectively, your transfer. It is possible to make it zero. The key in all of this is an appraisal. Is an appraisal that will pass muster. You can't give them a one-page job. You got to go out there and spend the dollars necessary from some professional appraiser that knows what he's doing. However, I don't know how many of you are in real estate who have seen the initials MAI, which means Master of the Appraisal or Member of the Appraisal Institute. But the lawyer in the back does know what MAI stands for. It stands for Made as Instructed. Okay? Now they're putting their butts on the line too, so you can't be greedy about this. But you sit with them and let these appraisers walk around in your shoes to know how difficult it is to run a business like this. And you can get some very favorable appraisals on that. Okay, a first cousin to the grantor retained annuity trust, especially knowing these people as I do. Every one of you in this room, without knowing many of you, are charitably inclined. And the first cousin to this is the charitable lead trust. It's a very aggressive transaction. It's a transaction that some may not like because you are giving a significant interest to charity. However, it overcomes the greatest disadvantage of the grantor retained annuity trust, and that is the risk of someone dying prematurely. What happens, and especially if you can afford it, what happens if instead of the grantor retaining an annuity interest for 8, 9, 10 years, and then it going to the grantor's son, the charity retains the interest? You get the same discount because it's charity who's retaining the interest, but you've eliminated the risk of dying prematurely. And that has worked in many an instance in the family business. Let's say the older generation has come to me 10 or 15 years after he should have. Well, let's say, heaven forfend, but it happens. Guy is told, you're a sick man. And, not good, you may be able to make it for 8, 9, 10 years, but you could go tomorrow. You're uninsurable, even though these guys can work miracles. You think about that. Certainly, we all have our organizations that we would like to be charitable to. Now, it may very well be that you would rather not have the charity as an entity that's interested in your business. But given the charitable inclinations that we all have, and given that 60% bite, and given the fact that your kids are in the business and they're earning a pretty good living, and it would be much better for them to wait a couple of years to get this interest and save that tax money, it certainly is a string to our bow which we should consider. The charitable lead trust takes away the risk of the grantor retained trust. And as interest rates continue to rise, There is a variation on the charitable lead trust that has worked for me that has really paid great dividends. It's got nothing to do with a family business, because the charitable lead trust gives you a charitable deduction for one purpose only, and that's for gift purposes only. For income purposes, the grantor still has to include that income in his gross income. Okay? The only way that you would not include that income in your, that you would be able to get an income tax deduction also. Oh, let's go back. The grantor will not include that income in his gross income. Will not include it in his gross income. Unless he wants also to get an income tax deduction. Remember, I said that the charitable lead trust gave you a gift deduction. Okay? But the charitable lead trust will not give you an income tax deduction, even though you're giving it to charity. Many people want an income tax deduction. And in order to get the income tax deduction, what you have to do is volunteer to accept the income produced by this trust as your own income. And if you accept that income as your own income, you'll get an income tax deduction. Well, you certainly don't want to do that if you are contributing to family business, because that is producing a lot of income. And so you'll have to do without the income tax deduction. But the benefits of the gift tax deduction may be so significant that you may want to do it. But you want the income tax deduction too? What about contributing tax-free bonds? You have to include the income in your gross income, but the income that you're including is the same character as produced by the trust. So therefore, it's tax-free bonds. And so you wind up not including it. We did this for a fellow who wanted to benefit Jayne. And what we did is that he contributed $1 million worth of bonds that had a 7% coupon on them. And this was when interest rates were lower, and this 7.8% was 6.2%. And so this guy got $1 million out of his estate, but the gift tax value of that was only $550,000. Okay, so he got $1 million to his kids. They had to wait 8 years, but they would get it. $1 million, and he only had a $550,000 gift tax consequence. But he also got a $550,000 charitable deduction. And with his income bracket, we used it up in 2 years. He got the municipal bonds out of his estate, he got the discount, he got the income tax deduction. He hit a home run. Leveraging your gift exemptions. There is one other way to leverage, and that is one of the last real glorifications of form over substance that we have in the tax laws today, and that is called the grantor retained income trust. Instead of saying, I'll pay you an annuity, or the grantor, I will retain an annuity, the grantor puts an asset, and a very special asset, and I'll get to that in a minute, into a trust and says, I will retain the income. And how do you value that? Again, the law of the case, the 7.8%. Now, until the law was changed 3 years ago, you could put anything into that trust. You could put even non-income producing property into that trust. And so long as the trustee had the power to sell, even if he didn't exercise that power to sell, you would get that deduction on the example that I used, the right to receive the property in the future. The code closed that loophole in 1991 with one very prominent exception, and that is a personal residence. Well, hold it, you say. What kind of income am I retaining? What kind of income does a personal residence produce? It can only produce one kind of income, and that's rent. What am I doing? Paying rent to myself? Right. That's the form over substance. You're not. But the code, actually the code itself, by statute, you haven't had to apply to IRS for a ruling, you haven't had to go to the court to litigate, the code itself sanctions what's called personal residence trusts. So back to my example. What is the right to receive, the value of the right to receive $10,000 10 years from now? Or more dramatically, what is the right to receive $1 million 10 years from now? Or whatever the value of the residence is worth. Well, we've got the tables in the outline, and at 7.8%, the right to receive $1 million 10 years from now has a discount of almost 53%. Now, this is the time to strike while the iron is hot, isn't it? Because residential real estate is still low. You can get low appraisals. And as friends of mine in the community have said, just wait till I get an appraisal on my Avenue R property. It's worth borscht. Okay, you can get an appraisal. If it stands up, fine. But the point is, the value of real estate is low today. And so what you're doing is that you're creating a trust in which you will retain the fictitious income we've just talked about, and at the end of the period of time, which you must outlive, it will go to your children. And by doing that, you will create these great discounts. Again, the leverage. You've gotten whatever the value of the house is out of your estate at sizable discounts. All right, there are two great disadvantages to that, you're going to tell me. In addition to dying before the term, there are two more. Number one, isn't there something called a stepped-up basis? And I only bought my $1 million house for $22,500 back in 1952. And I know that the capital gains rate is less than the estate tax rate, but I'd like to have my cake and eat it too. Well, in this case, you can do it. You do it by, as the trust is ending, let's say we take a trust for 10 years, you go and you buy the house back at fair market value. What was that? What is it?
Suppose the value goes down.
Ah, well then you won't buy it back, will you?
Of course not.
Okay, but only I, who can turn gold into manure, would have that. You wouldn't. Most houses have gone up, especially the houses that you're shaking your head because you got a Florida condo which is going into the dumper, right? Yeah. But let's take the what was that? Yeah, let's take the example of a house which you bought in 1952 for $20,000 that you've approved that is worth now $1 million. Okay. Now, if your children sell this house, they're going to have a whopping capital gain to pay. However, this is a special kind of trust. A trust in which the grantor retains the income. For income tax purposes is called a grantor trust. Has anyone ever heard that term? A grantor trust means that for income tax purposes, we ignore the trust. The grantor takes all the income tax consequences. So that means that even while the house is in the trust, you, the grantor, get the deductions for real estate taxes, for example. If you sell this house, you, the grantor, have the over 55 exemption, or you have the right to roll it over. Okay? If you are buying the house back from your own grantor trust, you're literally buying it from yourself. Therefore, there's no tax consequences. All right? So, let's say in the 10 years now, this $1 million house is now appreciated to $1.5 million. You take $1.5 million of assets, you put it into the trust, so you've still gotten $1.5 million out of your estate at a gift tax cost of maybe, not a tax cost, but a gift tax value of maybe $450,000, $475,000. piece of income-producing property. I like the income. All right? So if, let's say in the 10 years now, this $1 million house is now appreciated to $1.5 million. You take $1.5 million of assets, you put it into the trust, so you've still gotten $1.5 million out of your estate at a gift tax cost of maybe, not a tax cost, but a gift tax value of maybe $450,000, $475,000. You've gotten all of that leverage, plus now you own the house. So at your death, since you own the house, stepped up basis. And so you're having your cake and you're eating it too, and you're still using that leverage. I think a house is a painless asset to give because you don't miss it. It's not an income producer. The major type of pain that comes in making gifts is I've given away a piece of income-producing property. I like the income. The leverage takes care of that because for a period of years, you do retain the income. But remember rule number 1, you've got to survive the term. There will be a point in time in which that asset has gone away. It's gone to the people you want it to go to, but you don't have it anymore. And that's the essence of planning. I mean, it ain't easy. To walk that fine line between minimizing taxes on one hand and still not missing it, wanting, knowing that you don't have to go to your children for handouts. It's not as easy as it sounds. But to the extent that you can do it, it becomes a terrific estate tax saver. So the leverage is the thing. We've talked about the grantor retained annuity trusts, we've talked about the charitable lead trust, and we've talked about the grantor retained income trust, which we really now call personal residence trusts, because if your beneficiary of your trust is any member of your family, and family has a very expansive context to include brothers and sisters and nephews and nieces and all of that, the only asset that you can put into a grantor retained income trust is a personal residence. There's one more tool with leverage that has become very important because of a ruling that IRS made a year ago. And that is, we have always had discounts for what's called minority interest and lack of marketability. The whole is not equal to the sum of its parts. So if I own 100% of a family business and I give 10% of it away, that 10% is not worth 1/10 of the equity of the business. Why? Because who would buy a minority interest for 10%? They'd say, hey, I've got no voice in this. I'll value it and then I'll take a 40% discount. Maybe I'll buy it. Okay? And that's the essence of value. It's the fair market value, what a willing buyer would pay. IRS refused to go along with minority interest discounts when the transfer was made, when the gift was made to members of the family. Under the rationality, and it was rational, they lost in cases, but it was rational, that, hey, if I'm making a gift to my son, yeah, he's only getting a 10%. But if he has a bitch, I'm going to listen to him because he's my son. Okay? So there really isn't this arm's length. And we, in the family context, IRS said, are not going to allow minority interest. They lost 4 cases. The problem is in dealing with IRS, if they don't lose the case in your federal circuit, then the IRS has the right to go at it again. And the cases that they lost were in the 6th Circuit, which is in Chicago, is the head of that, and they lost it in the 9th Circuit, in which Los Angeles or San Francisco is the head of it. But here in the 2nd Circuit, which is New York, Or for New Jersey residents, the Third Circuit, which is out of Philadelphia, which includes Pennsylvania, Delaware, and New Jersey, there was no case. So in other words, IRS could litigate it all over again. Now you probably win your case, but you were buying a lawsuit, and that cost money. Last year, IRS published a revenue ruling. A revenue ruling is precedent which all Treasury employees, specifically IRS agents, must follow. It is the force of law within IRS, as opposed to a private letter ruling, which is just intended for the taxpayer it's given to, and has no precedential value. We all cite them because it's IRS thinking on the subject, but IRS is not bound by a private letter ruling. However, this was a published revenue ruling. The revenue ruling was very short, but it had the following facts. A father owns 100% of the stock of a company. He gives 20% of the stock to each of his 5 children. Just because, follow the negatives here, they're terrible. If you were a freshman English professor, you'd give it an F. Just because the donees are children does not mean that a minority interest won't apply. And this was the first time that one of the great lies of this world was put to rest. You know, the 3 great lies are: the 1, the check is in the mail; 2, it's only a cold sore; and the 3rd one is, I'm from the IRS and I'm here to help you. Okay? But in this case, IRS did help. IRS did concede that we lost these cases and we're not going to litigate anymore. That just because a gift is made to your children doesn't mean that minority interest doesn't apply. Okay, how does this work in the context of estate planning? It works in the context of what we call family limited partnerships. If I put an asset in a partnership, I've made no gift, or I may have made a gift to the extent that I transfer a small amount. But let's say I create a partnership in which I retain the general partnership right, and the general partnership is 1% of the equity. And I value this partnership at $100, and I have each of my 3 children kick in $1 for a 1% limited partnership interest. So upon my formation, my capital, I have contributed $97, each of my kids have contributed $1, and that means that I take back with my $97 a 1% general partnership interest and a 96% limited partnership interest. Okay? But the asset is not $100. The asset is a building. The asset may be closely held stock. And then I start gifting limited partnership interests. Am I not entitled to a discount for minority interest because I'm making a gift of 30% to each of my 3 children? So therefore, that gift, that 30%, is certainly worth far less than 30% of the equity of the asset, the equity of the partnership, the equity of the building. And so when the dust settles, I have gifted away property. I have retained control because I will to my dying day be the 1% general partner. But I have taken advantage of the discounts for minority interest and lack of marketability. And that will pass muster. That has passed muster by published ruling. That is your latest ground for leverage. And so, let's turn around now and apply these to the family context. I want to retain control. My family limited partnership. I want to retain control in the context of an S corporation. I'm making maybe a grantor retained annuity trust, but I still want to retain control. I recapitalize my corporation. Hold it, you say. How can we have 2 classes of stock? In order to qualify for S status, we can only have 1 class of stock. Ah, but we can. If the only difference is voting rights, then we can only have common stock, but we can have Class A voting common and Class B non-voting common. It's the analogy to my limited partnership. I retain the Class A voting, which is 1, 2, or 3, or 5% of the equity. I will retain that always. I give away the Class B. And so the key thing is to tailor the plan to fit the individual need. There is no right answer. The right answer is what you, sitting down with your advisors, determine it is. Each one of you has got different situations. You've got different family situations. You've got different business situations. You've got different partners. And really, when I talk to lawyers, I end the talk with the words, "it all depends," because there is no right answer. I'll end my talk with you with a little story about two guys who decided that they would be the first individuals to pilot a hot air balloon coast to coast, from Los Angeles to the eastern seaboard. This had never been done before. And they got in their hot air balloon, and everything was fine, until somewhere over the desert area, west of the Rockies, the balloon developed a leak and crashed. And the two guys were okay, but the impact was so hard that it knocked out their compass. They really didn't know where they were. Until about an hour later, a guy came along, and one of the balloonists said to this guy, "Can you tell me where we are?" And he said, "I sure can. You're in the middle of the desert under a downed hot air balloon." And he walked away. And the first balloonist said to the second, "I can tell this guy was a lawyer." He said, "How do you tell he was a lawyer?" I mean, he wasn't dressed like a lawyer. He said, "It's easy, because what he told us was absolutely correct and absolutely useless." Now, what I've told you tonight is absolutely correct. But how useful it will be, or how useless it will be, doesn't depend on me. It depends on you, and I leave you with that, and I thank you for your time. Now, please take these outlines that are here. It is a review of all the stuff that we discussed.
Double?
No, the question was, you're entitled to give $10,000 a year to as many people as you want. Let's take the example where I said I would give $10,000 to Joe, but he'd have to wait 10 years to get it. And I said that my discount was 50%. Does that mean I can give him double? The answer is no, because in order to qualify for this annual exclusion, the gift must be of what's called a present interest. Joe must get the immediate use of that money. And so if I give it to him in a trust, that means that he doesn't have the present interest in it, he has a future interest in it. And that means that it doesn't qualify for the annual exclusion. But, there's always a but. You can skillfully do it. Now, let's not use Joe. Let's use my kid. I want to give my kid $10,000, okay? But he's 8. And if I let him live long enough, because he's a pain in the ass right now, that's fine, okay? But I want to put it in a trust for him. Can I get the annual exclusion? The answer is if you do one of two things. If you require that all of the income be paid to that kid, then you won't get 100% of it, but since he's only 8, you'll get a very large percentage of it, over 90% of it. The other case is that you give to him an illusory power. It's really illusory. The right to withdraw the $10,000 from the trust for a period of 30 days. And since he's a minor, you give that right to his guardian, his parent. Now, nobody's going to exercise that right. The practical application of this is in life insurance trusts, okay? The way to get life insurance out of your estate is to put it into a trust so that you don't have the ownership of it. But how do you keep the life insurance policy going? You've got to pay premiums, okay? Can I get the annual exclusion for the premiums? Answer, no, because isn't the life insurance trust a future interest? Therefore, you can't get the annual exclusion. So what you do is that you give the beneficiary the right to withdraw the contribution for 30 days. Beneficiary is not going to exercise that right. You have then done it. But what you can't do is get the bang for the buck here, because in order to get the $10,000 or the $20,000 exclusion, you must give up present interest. That is 100% value.
It's better though to give them the $10,000 and let the interest.
Absolutely.
And then they'll get the interest. But by your example of the $1 million.
$1 million, right?
Okay.
With $125,000 income produced.
Right. So isn't it better to give it to him or to her and let them pay you 7.8%? They're benefiting 12.5%. So eventually you get your money back of $1 million, and they get the benefit
Okay.
of owning that $1 million without getting any of the.
The question is, I'm going to give to my son $1 million. I want to avoid the risk of dying prematurely. And so let him pay me 7.8%, okay, when the asset is really producing $125,000. That is a good idea if a couple of things apply. Number one, remember, since it is producing $125,000, he's going to have to pay the taxes on that. So in other words, he's got to both pay the taxes on this and give you the $78,000. Does he have the money?
The $78,000?
He can't deduct the $78,000 in interest because the only interest that's deductible is business interest.
Then you don't pay on the $78,000?
Yeah.
So they
Good
get you
try.
twice?
No cigar. They get you twice. No deduction to him. It's includable to you. And those are, you've got to work out the numbers, and probably because of all of those factors, it would be better to do the grantor retained annuity trust as I
There's
thought.
no invasion the other way. The way he's talking, but there won't be any invasion of the $1 million.
There won't be any invasion of the million. That's right. I mean, if you will be getting that $1 million out of your estate, there won't be any discount on it because it is $1 million and you're getting the market rate of return. You won't get your leverage, but you'll get the future appreciation out.
Now, the $10,000 you're talking about, so you just take out a check to anybody who wants to
Yes.
$10,000 without any questions, but you have to file a certain form.
The question is, what is the gift tax requirements?
Right.
If you give $10,000 to everyone in the Manhattan phone book,
Right.
you need not file a gift tax return. But you know about the $20,000.
Yeah.
Let's dispel a couple of misapprehensions about the $20,000. First of all, that $10,000 does not have to come from your wife. The $20,000 can come from you. But in order to get the $20,000, your wife must sign the gift tax return, that she consents that it be deemed to have been made $10,000 from each of you. Therefore, the filing requirement is limited to $10,000. When you go over that, $10,001, in which you want to split the gift with your wife, you have to file a return.
So $10,000, there's no filing.
Right. So if you've got a joint bank account of $20,000 and you give it to your son, there's no filing requirement because you gave $10,000 and she gave $10,000. But if it's your asset and you want the $20,000, then she's got to join it in it with you.
So if it's a joint asset, you give $20,000 without filing any.
Right, because it's $10,000 of it is hers.
Because it's joint.
That is correct.
You have two separate checks, or can you make one check?
Well,
This joint bank account.
if it's a joint bank account, then it can be one check. Because your wife has the right at any time under local property law to sever that account and take half of it.
So it's implied that the fact that she approves, even though you...
Yes, because it's her account. It's her account to the extent of half. And therefore, if you're giving 20, yeah.
Another question. If you're giving $10,000 in real estate, let's say you have $1 million piece of property,
Right?
and you give it to 10 different children, you give them $10,000 apiece. Now they own
Then they own 1% of that real estate.
estate.
And so you would have to change the deed. This is a great candidate for a family limited partnership. You put the piece of real estate in the Jones family partnership.
You have to
Okay.
file a form for that?
You've got to file one deed. Because now let's take your example to its logical conclusion. You begin a plan to give and let's assume that the property doesn't appreciate, okay, so it's $1 million. You're going to give, over a 10-year period, 1% to each of 10 people, okay? That would mean that each year, for 10 years, you'd have to file a new deed, okay? But now, if you just do it in year 1 and you become the Jones Family Partnership, okay, then all you're making is bookkeeping entries. You only have to file 1 deed because the owner is the partnership, not you.
Everything that defines the home, everything is good. But what happens if you have a blank sheet right now? And you have a child maybe that's not happy with the whole situation and he wants out. What happens then?
Well, he's only a partner, and if it's a minority partner, he cannot dissolve the partnership.
He can be bought out?
He can be bought out. And so that's where it comes in. It all depends. You've got to really think this thing through. I'm here for as long as you guys want, so fire away. And Joe Shalom's here as long as I got his watch. Yes, sir.
How do you structure something where you have a number of different partnerships in real estate and the amount of equity that you own in each of them is different? They'll be back.
Well, I think for also asset protection reasons, the question was, you've got a lot of real estate here. You've got, let's say, 7 buildings. I think your question is, should you put the 7 buildings into one partnership? I don't think so. I think you should, because of your different... yeah, well, you can always reconstitute a general into a limited partnership, but I think what you would want to do is keep each building in a separate partnership, because if somebody slips and falls in front of building A, then the only right that he has is against building A. And you wouldn't want to have 7 buildings. That's why it's in a corporate form. That's why every taxi cab corporation has only 2 cabs in it. Okay? That's the maximum they want to put in it. So, I mean, that's the only thing they'll walk away from it. Because the only insurance a taxi cab has to have is like $10,000 liability. So,
in other words, you would have that you basically have a format. Each of the partnerships would be
each of the partnerships. That's right. That's right. With its own deductions, and it also is great asset protection too.
But then if you went to sell one of those buildings during that, say, 10-year period, then that obviously would make it null and void that one particular.
That one, yes. I mean, well, the partnership would continue. It would just have cash unless the partners voted to dissolve. Well, I really appreciate it. I think the questions were good, and I hope I put a couple of those points in your mind.
Coffee going to be served, hors d'oeuvres coming out.
How about Jackie?
Jackie, are you closing with some? Hey, folks.
I waited for you to
Jackie rehearsed this for 3 weeks. Please give him his.
Oh, I'm sorry. Okay.
Well, thanks, that was fantastic. So I speak to the broken audience. You know, it's not easy to pull you guys out of your businesses, but due to the importance of this topic, I thought it was worth our best shot to bring you out here. So I want to thank you all for coming. You know, looking around this room, I feel privileged to have the opportunity to address this audience because of the tremendous amount of respect that I have for each and every one of you. And at the risk of sounding a little corny, if someone was going to ask me to describe the men in our community, my reaction would be that they are extremely hard workers, smart, very focused individuals with an endless drive to succeed. I would continue to say that they are also very dedicated to their families and their community. Many are very successful, and besides being very charitable, they receive a lot of satisfaction from enjoying their wealth with their families. That, in a nutshell, is what the seminar is all about. Love for our families. Our role at Shweky Associates, and by working closely with CAP Planning, is to quarterback between your accountants and attorneys. Our primary concern is to monitor our clients' planning so that it's at the cutting edge in order to maximize the transfer of their hard-earned wealth from one generation to the next. The message is clear. We pay taxes all of our lives in this world. Why do we have to pay taxes in the next world too? You know, when the opportunity presented itself to have the distinguished Arthur SEDERBAUM speak to our clients and friends, we couldn't let it slip away. So on behalf of myself and Shweky Associates, I'd like to once again thank Mr. Arthur SEDERBAUM for speaking tonight. I'd like to also thank our associates, Harold Washinsky and Mike Dukoff, for their support in putting this seminar together. And once again, I'd like to thank all of you for taking the time out of your busy schedules to show your concern to this extremely sensitive issue by attending the seminar. In closing, I'd just like to say that we are here to help you reach all of your financial goals, and the only way to do that is through proper planning. Remember, nobody plans to fail, they just fail to plan. Thanks again, have a great summer.